Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So I got an interesting question the other day, and I was asked that, hey, do you think Canada is going to do another rate hike? Well, when I look at the rate hike expectations, according to this, by December, there's an 83% chance that we could see another 25 basis point rate hike. Now, why is that? Right? Why are markets and bond traders expecting another rate hike? Aren't we done with? Didn't Bank of Canada just pause rates? They didn't hike. Isn't that supposed to be good and done and that's it? We're done for the year? Not necessarily. And I've been saying this on this channel for a very long time. I said, guess what? Yes, inflation has come down. Yes, the government came out and they started celebrating that, look, in the summertime, inflation's down, we're achieving our goal. And I said, hold on there. This can all change very rapidly, especially with oil prices that have been going up, right? We've seen oil prices go from $60 a barrel to now $93. This is crude oil I'm talking about, WTI crude oil. If you look at the futures market, crude oil is hovering around $93 and fluctuating there. So that has seeped into higher prices, higher inflation, and that's why the last inflation report that we got from Canada ended up being a little bit hotter. So you expect that inflation just doesn't come down to the target of 2% and done. Expect there's going to be spikes. And we heard that from Bank of Canada. We heard that from other central banks around the world, even from the Fed, the US central bank, where expect these, spikes. We expect that, there's going to be some spikes in the inflation report, and we still got to keep things tight because they can't call it as if, they're winning all of a sudden. Because if they do it too prematurely, then they can really screw up things. Because that's when, inflation can really run away from them, and then it could go out of control, and then there could be way worse consequences from that happening. So the fact that Bank of Canada paused doesn't mean that they're done. There's an 83% chance that they can hike in December. There's one more rate hike for this year. Same with the U.S. Federal Reserve as well. Although the probability in the U.S. side is more lower than for the Canadian side. So there's about a 50-50 chance in the U.S. for December. But things can change rapidly. And why do I say that is because data. It's going to be important. October, November, December. What's the data going to look like? What's oil prices doing by then? What's the inflation report looking like by then, right? If those numbers continue to be hot, then yes, 100% you're getting that rate hike. You're getting that rate hike for sure. So let's go over Canadians' inflation report, the CPI report, the recent one that came out, because that's going to give you some understanding of why this market and why traders are expecting an 83% chance that, December, we could get another rate hike. Now, keep in mind, this probability can change. It could go higher, it could be like 100%, or it could be lower, right? Depending on, again, the data. It's all about the data. So here we are. CPI rose 4% year over year in August, following a 3.3% increase in July. So, in July, when CPI was 3.3%, everyone was happy. Oh, look, it's coming down. We're getting close to the 2% target. And lo and behold, oil prices went up, things changed, and now it's sitting at 4%, right? And the headline accelerated was largely a result of higher year-over-year prices for gasoline in August, plus 0.8% compared to July, which was negative 12.9%. Yes, gasoline prices are volatile. It can cause the metric to go up and down, and we've seen gasoline prices go up quite rapidly. This is going to be important. WTI, West Texas Instrument, crude oil, look at the futures market, how they're trading. That's going to be important because that's going to seep into the inflation report, the headline report, and most importantly, this is what the consumers look at, right? And we heard from central banks before that this is a problem. This is a problem because if we see higher inflation, higher oil prices, and that's a result of the higher CPI report, then that's going to seep into the consumer sentiment and expectations that, hey, inflation's sticking around for some time, and that's going to reflect in the spending habits as well. And the central bank doesn't want that. The media reports this headline number. You go down your local gas station, you see it there. It's not a good sign. They obviously want to control that, right? Even though maybe some central banks, cough, cough, the U.S. Central Bank, the Federal Reserve said that we look through oil prices and, it's volatile. It doesn't matter so much. It does. Trust me, it does when it comes to the consumer sentiment, okay? It does when it comes to growth, GDP. When consumer spending makes up 2/3 of GDP and growth, it does matter. And especially, I'll tell you one thing, if oil prices continue to go up, $100 a barrel, $120, $130, we make new all-time highs, trust me, it's gonna matter. Going back to this, it says, excluding gasoline, the CPI rose 4.1% in August, matching the 4.1% increase in July. So taking out gasoline, right, and just looking at the CPI report, it was unchanged, 4.1%, which is still high, which is still above the target of 2%. So this, in addition to facing higher energy prices, what else is causing pain for Canadians? Canadians paid more in terms of rent, mortgage interest in August, right? As funny as this sounds, interest rates are supposed to bring inflation down, but in fact, it's feeding into also high inflation because that's feeding into higher rents, right? Higher mortgages, right? You go and renew your mortgage, it's going to be higher, the cost is going to be higher for you. So the shelter component in the CPI is going to be higher. The landlords, right, who own investment properties, they're seeing their mortgage rates go up, they're going to pass it down on the rent. Rent's going to be higher, so forth and so forth, right? Until when, right? Until when does this stop? Until something breaks. And that's where it looks like a lot of central banks are heading towards, keeping things tight until something breaks. So yes, let me say one thing though. Higher interest rates is causing a higher inflation in the rent, mortgages, in the shelter component of inflation, but also it can be disinflationary. Why so? Because as you hike and hike and hike and hike and hike, eventually something should break. And if you look at history, if you look at previous rate hike cycles, as central banks have raised rates, you get a liquidity issue in the banking sector, you get some sort of maybe credit event that causes things for the economy to be on a standstill and a halt. The banking sector is affected, like we saw this year in March in the US, the regional banks that were going under. And if we get another round of the banking sector or something, some credit event to come in, then that can be very disinflationary, and that will cause prices to come down. So yes, it will create pain, inflation going up, and then you get the plunge after the shit hits the fan, is basically what I'm saying. Okay, going more into this report, the monthly slowdown was mainly driven on a monthly basis, the CPI was up 0.4% in August, following 0.6% gain in July. So that slowdown was driven by travel tours, minus 6.4%, air transportation, minus 6.9%, as prices fell month over month following the peak of summer travel demand in July. So airlines have said this, we're seeing slowdown in demand. We're not having the pricing strength that we had before. We can't offer higher prices in the tickets. You're seeing some discounted airlines, and on top of that, oil prices are moving up, so their costs are going up, right? So this is what I said, right? It's starting to happen. The airlines are telling you that as things continue to remain tight, the consumers are going to feel the pinch. which is going to seep into the businesses. The costs are still up for the businesses, and especially if oil prices go up for certain industries and companies, they're going to feel more of the pinch there. And that's going to create a very big issue for them because they see a slowdown of demand and costs are going up. So what happens there? Guess what? Layoffs, right? And it happens slowly. It doesn't happen right away. It's not chop, right? It will happen. That moment will happen when you see this pause in the rates. You see, again, things really slowing down, the demand really rapidly falling down, right? The growth numbers are really dropping hard, and then that's when the layoffs start to kick in even harder. This is just the beginning. Going down in this report, it says gasoline prices increase year over year. We know this already. Shelter prices accelerated, led by rent. Shelter prices are up 6% year over year in Canada in August after increasing 5.1% in July. So guess what? Rate hikes are leading to higher rent, believe it or not. Very interesting here that there's certain provinces where they saw the fastest price growth. Newfoundland, for example, plus 8.4%. Newfoundland being the top one in those prices. Alberta next, 6.5%. Nova Scotia, positive 9.5%. Sorry, Nova Scotia is the first one. Then Newfoundland, then Alberta, 6.5%. So Nova Scotia, 9.5%, Newfoundland, 8.4%, Alberta, 6.5%, and Manitoba, 6.1%. What do all of these provinces have in common? Well, guess what? Ontario, right? If you go to and live in BC, rent prices are crazy. Buying a home there really expensive. It's almost impossible for a lot of people. So leave those provinces, chase the provinces that have better affordability, and there you go. That's why those provinces have seen much of a rise. Like for example, Nova Scotia, positive almost 10% increase in their price growth. Pretty crazy there. It says mortgage interest cost index also contributed to the shelter prices, like I was saying. Faster pace in August, plus 30.9%, in comparison to July, a positive 30.6%. All right, let's get into groceries. So price for groceries in Canada slows but remains elevated. Okay, we're getting a slowdown in food. And it says here that prices for food purchased from stores rose 6.9% in August compared with 8.5% increase in July. On a monthly basis, prices of groceries were down 0.4%. But when you look at certain foods, let's say fresh fruit, plus 0.2%, cereal products, plus 9.8%, fresh or frozen chicken, plus 8.9%, increased at a slower year over year, but still, again, elevated. And then if you look at beef, plus 11.9%, coffee and tea, plus 9%, sugar, plus 10.9%. So food is still up there. So what's the trend you're seeing here? The trend you're seeing here is that your essential items are still elevated. Your food, your shelter, your mortgage cost, everything that is essential is going up. Therefore, the non-essential, like travel, leisure, and all of that, are going down. So you're seeing that in that report, and people are making those decisions that, hey, I can't go on that fancy vacation, or hey, get rid of this, Netflix subscription or whatever. I'll just, watch free videos on YouTube or whatever, right? You're seeing those changes in the spending habits, and the businesses are starting to feel the pinch. This is just the beginning, like I said. So overall, right, going back to the question, are we going to see a rate hike this year? If things continue to be elevated for some time, there's no credit event, there's no massive, crisis, and data continues to be hot, resilient, economy looks fine, then yes, 100%, expect another rate hike this year, and then for next year, the markets are pricing in we're going to start to see rate cuts. But guess what? That can change, because last time the markets were pricing in we were going to get rate cuts this year. We didn't get it. All the realtors, all the mortgage agents out there saying, guess what? We're going to get rate cuts. They're going to come in December of this year. It's all going to be fine. Lock in your rates, blah, 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 or get your variables, or etc. And what happened? Rates went up. Bank of Canada, just a couple months back in the summer, right? They hiked rates. They were in pause mode. They hiked rates. They went to pause again. Well, it's not really a pause. It's just a little tiny break. And guess what? They can come back and hike again in December. So this is not over. Although you may think that the economy is fine or not, but according to the data in terms of labor market, right, it may look strong or resilient. It takes time. These indicators, the economy works with a lag. It takes time to see those effects of those interest rates, and then you'll see how this all plays out next year. And if there's rate cuts next year, doesn't necessarily mean that's a good thing. That means that, hey, something has broken, right? And if nothing breaks by then yes, higher for longer. Either they hike or they pause rates. For the average pause tends to be, let's say, around 6 months to maybe a year, let's say, at most. And then the cut starts to happen. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.